Investing is easy when you know the rules, and there are only 8 rules to investing, according to my guest on today's show.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the 4th time he's won a similar award in the last 6 years.
If you're interested in becoming a successful investor, having more money, more choices in life, today's show's for you because my guest tells us that investing is easy when you know the rules, just like it is if you know the rules to Monopoly. Now, investors never build the portfolio they expect. Most business people never have a successful business. Most share investors never get the freedom they want. So, welcome to this week's show as we discuss the 8 rules of investment with my guest Stuart Wemyss, and maybe we can help you understand how to become a more successful investor. My special guest today is Stuart Wemyss, Director of Pro Solutions Private Clients. Now, Stuart is a financial planner, an accountant, a mortgage broker, and a successful property investor. But more than that, he's also a best-selling author who's brought out his 3rd book, Investopoly. So welcome, Stuart.
Thanks, Michael. Thanks for having me.
Now, that's an interesting name, Investopoly. Where did that come from?
So it's a play on the title of the board game Monopoly, which I'm sure both of us have played over the years, and I'm sure we're probably equally bad losers too, I'd imagine. True, Michael?
Well, I've actually played as an adult, and it's now I've realised it's not a game of luck. It is actually a game of skill and strategy. You need a bit of luck.
Yeah, of course, and it's kind of return on luck. So if the luck presents, whether you're going to take it or not, and just like in Monopoly, I think there's some rules that you can follow in terms of accumulate as much property as you can, make sure you've got some cash reserves, collect the first set as soon as possible. Those sorts of rules will certainly help you win more games than you lose, and my sons can certainly attest to that. Even if they're very grumpy about it, but that's okay. And so I believe that building personal wealth is actually very simple. You just need to understand the game of money, and you can solidify that, I believe, into 8 simple rules.
I look forward to working through those with you. But you sit with clients all the time, and I used to, my team does now, and I've found that it's not just understanding the rules. You've actually got to stop people making mistakes. You've got to stop people from doing what they feel like doing, getting emotionally involved and sticking to the rules. There's a whole science of behavioural finance, which as a financial planner, I'm sure you understand.
Yeah, absolutely. So I think people tend to overthink it. And I think by adopting some rules and building some rules around the way you deal with money will actually prevent you from doing that. I actually think intelligence is an impediment when it comes to building wealth. That is that people that sort of think or are sort of smarter than the average bear tend to take a very proven, and whilst it might be simple, but proven low-risk strategy, and they think, oh, look, that's a bit boring. I'll add my own little 5% or my own little twist just to dial it up a bit. And as a result, they tend to ruin the complete strategy.
I see that so often. People say, Michael, I followed your strategy. And I say, no, you didn't. You've taken bits of it that you think suit you. You've added your own bits to it. Then you say it doesn't work, and you blame me. At my seminars, I say, hands up the intelligent people in the room, hands up the analytical people in the room. You're in trouble. I often say some of my most successful clients are dumb because they just follow the rules. So you've written out some rules of wealth creation. So can we work through them one by one?
Yeah, sure. And I'll say before we get started, Michael, that these rules aren't my opinion. They can be proven with simple logic, simple maths. A lot of them are rooted in academia and peer-reviewed studies and these sorts of things. So, and I'll also say that there's nothing complex about building wealth that can't be understood or simply explained. And I'd say to people when I meet them that if you don't understand, then you're either going to find someone that's going to explain it in a simpler way, or maybe that person's creating complexity. Maybe the whole idea around creating complexity is their business model, and in which case you should walk the other way.
Well, I think you made two good points there. First of all, we weren't born knowing how to do money, so you've got to learn it from somebody. But I think Einstein once said that if you can't explain things simply enough to explain it to a child, you don't understand it properly yourself.
Yep. Yeah, perfect.
So you've made some simple rules. Golden rule number 1, Stuart.
Is play the long game. So that is really about taking a long-term approach when thinking or developing your own financial strategy. So really the best question that you can ask yourself is, what can I do today so that in 10, 15, 20 years, you're financially stronger? That almost always avoids making financial mistakes, because financial mistakes are often made by thinking too short-term. And thinking short-term then makes you worry about what a market's going to do in the shorter term, and it creates anxiety. Whereas if you have a look at returns in markets over long term, so let's say from 1980, last 30 years, the Aussie market's just the appreciated has just over 9%. The Melbourne and Sydney property markets have done about 12%, and the US market about 10.5%. So you're looking at circa 10% return, whether you use a combination of those asset classes or one. It's going to work. It's all you need. You don't need much more than 10% compounding return in the long run to build wealth. So it's not really about timing or anything like that. It's really about strategy.
That makes a lot of sense. But so there are how-to investments and when-to investments. And I think you've just explained, you and I like how-to investments, where you've got to learn how to do it and just let timing, compounding, leverage do its magic. But there's a lot of people who try the when-to investments, and that involves timing, and it's so hard to get it right. Last week I did a seminar in Sydney, and I explained to people it takes 30 years to become financially independent through property. And in the break, a young guy came up to me and he asked me 2 questions. The first one made some sense, and the second one, I'm sure others thought as well. Yes, Michael, but how do I take a shortcut? I can't wait 30 years. How do I get rich in 5 years? And that's when they make mistakes.
Yeah, it's Howard Schultz, who built Starbucks empire, who only recently resigned from Starbucks, has a fantastic quote. Probably my favourite is that short-term profit doesn't drive long-term value for anyone. And it's completely true. So you might be able to, if I told you a stock tip today that the stock was going to double in value in the next 6 months, that's great. You can go and invest in that stock and you can double your money in the next 6 months. But then what? Then you have to think about another idea or another opportunity. And of all those ideas and opportunities, what's your success rate going to be? Maybe 1 out of 20, 1 out of 100. It just doesn't work. Instead, what you need is a rules-based approach to invest in assets, because rules repeat themselves without your own input. And that's really what you want.
So therefore, a strategy, a set of rules, takes the emotion out and stops you looking for all those so-called opportunities that come past your desk, and it'll allow you to say no to more things and yes just to the really good ones.
And it's a little bit of delayed gratification in there as well. That you've got to realise that patient investors are rewarded and impatient ones are punished.
So these rules come from your new book, Investopoly, and rule number 1 is play the long game. And there's no doubt that delayed gratification in all areas of your life, whether it's telling your kids to stay at school, get an education, or investing, or building personal relationships, it definitely makes a big difference. Rule number 2, Stuart.
Begin with the end in mind, I should say, which is really from Stephen Covey's book,
of course.
7 Habits of Highly Successful People or Efficient People. I can't remember the title. But really it's about, you don't need a map if you don't have a destination in mind. So quite often when I meet people, typically you ask them, so what's the goal? When do you want to retire and what does retirement look like? A lot of people haven't turned their mind to it. So I think there's 2 things here. One's financial and one's non-financial. The non-financial thing is I think people under-prepare for retirement. So typically work provides a couple of things other than just money, typically contribution and growth. We're contributing to something that's not ourselves, and growth in terms of we're continually learning. And these are from Maslow's hierarchy of needs in terms of this is what humans need to be happy and satisfied and so forth. So if you're going to stop work, or you think, if you're racing towards a goal of not working one day, what's going to replace contribution and growth? Because you need to start thinking about that. The second thing in terms of the financial one is you've really got to have a goal, and any goal is better than none. So it doesn't have to be really detailed, but essentially you want to know two things. When do I want to have the flexibility to not have to work? And how much money do I need in retirement? And people sort of struggle with these, so maybe I can give some help. Most people want to sort of stop working. Or firstly, a lot of people these days don't want to just stop working. They just want to have flexibility, maybe wind down, maybe wind back to 4 days or 3 days a week. Yeah, I work 4 days a week now, and it's very easy to do, and maybe I'll go down to 3 days eventually, and I think I'll probably do that for the rest of my life. So, but then it's thinking about when do you want to have that flexibility. Most people can access super at 60. 60 is, in the absence of any other goal, 60 is a good age to aim for.
But now with the extended lifestyle, you've got another 30 years of having to look after yourself. And I've found out your kids are still a bit younger. It doesn't stop when your kids leave. Now it's grandkids and other things. So the bills, if you want to leave a legacy, still keep coming in. And I think a lot of us do want to leave a legacy for our family, for our kids, and for the community. So you probably need a lot more to retire than you think you do.
Exactly right, Michael. And we'll get to that in golden rule number 4, which is really a combination of assets that you know, hopefully that even in retirement, your assets are still escalating rather than you're eating into capital. But spot on. I'm 43 today. My statistical lifespan is somewhere 83, so another 40 years. But
halfway, well done.
Halfway, yeah, bang. I feel proud. But you know what's going to happen over the next 40 years in terms of technological and medical advances and so forth. Tech billionaire Mark Cuban said late last year that he thinks the technology advancement over the next decade will be more than the previous 3. And so it's just that compounding.
The exponential growth. So I guess what it means is you're going to require a lot more in retirement than you think. First of all, because you shouldn't compromise on your lifestyle. And number 2, you're probably going to live a lot longer. So you don't want your money to run out before you do.
Exactly right. And when it comes to thinking about how much do I need in retirement, it's a very difficult question to answer. So again, in the absence of a goal, I would just use what you're spending today. It's a good quasi for what you'll need in retirement. Some expenses will disappear or be lower. Other expenses will be higher, but it will be about similar, I think, in the future, obviously adjusted for inflation.
So rule number 2 from Investopoly is know how much income you need and by when. As you said, set goals, and most people don't. So what you've got to do is start planning. Plan to become what you plan to become. Bring your future forward to today so you can plan for it, so you've got some control. Because if you don't take control, no one else is going to look after you. You're going to be some part of somebody else's plan. Rule number 3, Stuart.
Number 3 is spend less than you earn and invest the difference. Pretty simple rule, hey? So, of course, if you're going to spend everything you earn or even sometimes more than you earn, there's nothing. I'm not a magician. As a financial planner, I can't build a retirement strategy for you. So it's really about committing to an annual surplus investable income, and then spend what's left over. So that could be $5,000, could be $10,000, could be $50,000, depending on your circumstances. How much do you want to contribute towards your future? Then you can then decide, using these rules that I'm going to outline, where that goes. You know, whether it goes into home loan repayments, whether you go and buy an investment property or put some money in super. Could be lots of different things, but the key thing is the consistency of each and every year, making sure you pay yourself first.
So that probably means you've got to do a budget. People hate doing those. From my mind, a lot of people do a budget and see what they've spent in the past. I'd be doing it differently. The budget should be allocating where your money goes in the future, which is exactly what you're saying.
And the most important thing first, right, which is building wealth. So you allocate that one first off. And money management is actually quite simple. In my experience, you can't manage what you don't measure. So if you're not measuring it, it's impossible to get ahead. But just the mere fact by measuring it will actually help you improve, even consciously or unconsciously improve your cash flow management. So I'll give you an example. I had a client a few years ago that in the same situation, like many people, they weren't really monitoring their expenditure. They worked out that they paid their gardener $5,000 a year,
Really?
right? And they didn't have a significant. They lived in Malvern, which is a great suburb in Melbourne, but they didn't have a great house. But the garden was pretty basic. It's just the gardener came whenever the gardener felt like they wanted to, and did some work and left them a bill. But they didn't want to spend $5,000 on a garden. So the thing is that the people waste money on things that don't actually add anything to their standard of living. And that's the stuff that you can trim out. And that's the stuff that most people can trim out. But you can't do that unless you track where your money's going.
I think people don't recognise the significance of what you said. This point, spend less than you earn and invest the difference. You can be flippant about it. But if you don't do that, all the other rules are pretty useless.
Absolutely useless. And there's some tips and strategies that you can employ that help you manage money better. So a really good one, for example, is because, we might die tomorrow, right? So, should we spend everything today? Well, no, but it doesn't mean we should save everything today either. So going out to dinner, I think in my life is very important. My wife and I go out to dinner and we have a lovely time, and I wouldn't want to not do that. But if I was spending $20,000 a year on meals out, and I thought that was too much, well, I'm not going to just say I'm not going to do it anymore. Reduce the regularity or reduce the spend per dinner, for example. So you're not depriving yourself, you're just putting some limits on it. And if you can do that with a couple of large item discretionary items, it has a big impact.
There's an element of what we said in the previous rule, the delayed gratification. In other words, if you want to get a nest egg, if you want to build an asset base in the future, really what you've got to do is spend less than you earn and understand that you're now building something, so you've got lots to spend in the future. That means, as you say, maybe a bit of sacrifices, and maybe just getting some outside people to have a look at it as well, an accountant, a financial planner.
Yeah, certainly. And there's lots of tools these days to really help you track your expenditure. And all you need to do is just put it into maybe 5 or 6 different categories. You don't have to go down to every dollar and cents. No one wants to do that. That's a painful process. But just at a high level, because there's lots of things that you can't control, like utilities or home loan repayments, these sorts of things. It's mainly just the discretionary items. And typically for people, most of their leakage, if you like, is just 2 or 3 or 4 different items.
It's so easy to spend today. You don't have cash. You don't even need a credit card anymore. You just tap your iPhone and the one click on the internet. So I heard a very good strategy is not press that one click straight away. Keep it saved in your shopping cart online. And if 24 hours later you come back and you still think you need it or want it, then do it. But it's so easy just to hand over the card or tap your card and buy something.
Dan O'Reilly, who's a researcher, I think he works for Harvard. His recent book is called Monies and Cents. And anyway, he does studies on human psychology and marketing and these sorts of things. And I can't remember the proportions, but he worked out if people were given cash or credit, that people spend somewhere like 50% more on using just card as opposed to physical cash. So if you're going on a discretionary shopping expedition, based on that research, you're better off to go to the bank, get the money out of the bank, and then go and shop.
Very interesting. Of course, the other mistake people make is thinking that their credit limit on their card is theirs. It's not. It's the bank's, and you're actually paying for a privilege of having it and paying interest on it. So that's another mistake people get. Or go to Harvey Norman, get 3 years interest free, and all of a sudden the time comes up and they've got to suddenly pay a very high interest rate. So rule number 3 from Investopoly is spend less than you earn and invest the difference regularly, though, which is important. Rule number 4, Stuart.
Number 4 is you need to grow your asset base in 2 steps. So you need to firstly grow your asset base, then tilt it towards income. So it's a little bit like playing golf, if I can draw that analogy. You could tee off with a putter and you'll probably get to the green, but it'll take you probably 20 shots and you'll look like an idiot and it'll be a lot of hard work.
I know what you're talking about.
It's been a long time since I played golf, but I'd certainly look like an idiot today if I did. So what I'm saying is that the quickest way, the most efficient way to build wealth is firstly, you've got to build your asset base. So the error that people think is they think, okay, I'm going to work to generate an income. So if I want to have the flexibility, not have to do that anymore, what I need to do is invest and find assets that are going to replace that income, right? Which is probably logical. But
You
actually,
can see why people do it, but it's not right.
it's not right. That's right. So, but that's just not going to work, and I'll explain why in a second. What you really need to do is build your asset base first, and then start thinking about income. So, if someone walks into my office and says, "Stuart, I'm 60, I want to retire, I expect to live for the next 30 years, and my asset base is $500,000, work out how I'm going to be able to do that." Again, I'm not a magician. I'm not going to be able to do that. If they walk into my office and they've got $5 million of equity in property, for example, a liquid asset, but, okay, Stuart, work out how I'm going to retire. Well, that's doable, right? So it's all about asset base. And mostly it's because about two things: tax and the ability to reinvest your returns. So if we just very quickly compare two investments, both earning 10%.
Yep.
One, however, is giving you 4.5% income and 5.5% growth, which is about what the ASX 200 does, right? The other investment giving you 2% income and 8% growth. So that's pretty much what property is doing.
2% net after you pay everything. Sure, that's right.
Yeah, correct. So saying 10% overall return, after 20 years, if you then sell all the assets, you pay income tax along the way and you pay capital gains tax on the way out, the investment that gives you more growth and less income gives you a 21% higher return.
Big difference.
Same asset, same overall return, it's just the makeup of the return that's different, and 20% or 21%, that's a pretty significant amount of difference.
I think the reason a lot of beginning property investors go for cash flow is that thing we spoke about before, not having the delayed gratification. They think a couple of dollars today in their pocket is going to make a difference. It isn't. People come to us and say, "Hey, Michael, I'd like to buy an investment property. It'll pay for my school fees. Or can I buy an investment property? I want it to pay for my holidays." Doesn't work that way. So I think one of the bits in your rules here also is let your assets keep working for themselves and compounding. You can't take out money along the way either, can you?
Compounding growth is the easiest way to financial independence. It does all the heavy lifting for you. You only need to talk to people that bought an investment grade property in the 80s, and the numbers sort of tell you the story by itself. So
what you're saying is select assets that provide more capital growth, and in return for that, unfortunately, you get relatively less income. But in time, as the capital growth goes up, the rental returns increase as well. And the capital growth isn't taxable. That's the great thing about it. And you can leverage and gear over time with that as well. So there are the three stages in my mind. The first stage of your investment, your wealth building, is building your asset base. Then you slowly transition to lowering your loan to value ratios, because to build your asset base, you need a level of leverage and gearing. Mm-hmm. And then eventually you've got some choices. You can sell some, you can sell all, you can get rid of some of your debt, you can live off equity if the banks will allow it in the future. But if you don't have an asset base, you don't have many choices.
No, exactly right. So if you're in that financial position where your asset base is low, then all you need to be thinking about is capital growth. Forget about income. You don't want more income today. You'll pay more tax. Half of it will go to the government and you'll have half left over to reinvest. It's not going to work. And property, of all the asset classes, property is by far the most effective here, because it gives you the highest proportion, good quality investment grade property obviously, gives you the highest proportion of capital. And mathematically, if you could design a perfect asset, you'd only want $1 of income. That'll make the debt tax deductible from a taxation perspective. And you want all the rest in growth. It's all about growth.
And most people don't recognise that. But in my mind, residential real estate is a high growth, relatively low yield investment. Now, interestingly, as you get further on and you're the financial planner, you then may choose to have some cash flow assets, whether it's shares, whether it's commercial property, because eventually you're going to transition and want to have cash flow. But the first stage, and it'll take a couple of decades really, is building an asset base. So, Stuart, we've covered 4 of your rules so far from the new book, Investopoly, and I want to go through the others. So, if it's okay, I'd like to continue our conversation in next week's podcast when we go through the other 4 rules. Will that be fine?
Absolutely. Love to.
So, Investopoly from Stuart Wemyss from Pro Solutions Private Clients. Where did they get the book Investopoly? And you promised a special deal for listeners of my podcast.
I did. Very simply, just go to investopoly.com.au and you can follow links to buy the book there. And if you use the code Yardney, I'll give you a 30% discount.
boy, I know since you've got a publisher, there's not much in it for you, but I also know your motivation, and it isn't to make money out of the book, it's to spread the good word. And that's why I'm really, really happy to have a chat with you, because your lessons so far have been golden. They are golden rules. So I look forward to having another chat with you next week. Now, the listeners of the podcast know that we're going to continue on the conversation now. They know that we're pre-recording it. But in the aim of having these as bite-sized chunks, let's come back next week and have another discussion.
Fantastic. Thanks, Michael.
Thanks for joining us for this week's show, because we ended up discussing 4 of the 8 rules of property investing, but clearly there's a lot more to talk about, so I've asked Stuart to come back next week, and I look forward to joining you again when we can go through the balance of the rules, because, boy, there was a lot of gold in today's show. And we're also going to talk next week about how to select a trusted advisor, so watch out for the next episode of the Michael Yardney podcast on iTunes, Stitcher, or if you subscribe to my Property Update blog, you'll get information about that as well. I look forward to joining you then.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You learn some new ideas about property investment, success, and money in around 20 minutes.